The word asset is arguably one of the most used words in the finance world, and it is crucial to know if you want to understand your own finances. It can have different meanings in different scenarios, however today we will be discussing what it means in the financial world, in particular on a balance sheet. My friends, you've found yourself watching the Money Playbook, where our aim is to help you learn about the huge world of finance. If the world of finance excites you, make sure you're subscribed and you destroy that like button. So, the definition of an asset is widely recognized as anything owned by a person or business that provides value to them. That can be anything from a worker of a company to a printer or a computer sitting in an office. Investopedia officially defines an asset as a resource with economic value that an individual, corporation, or country owns or controls with the expectation that it will provide a future benefit. So knowing that an asset provides value, they are then split into two categories, and that is tangible and intangible assets. Tangible assets are assets that you can touch. These can be things like property, if it's owned, any stock that a business or you may hold, desks, chairs, company cars, etc. And the other type of assets are what are called intangible assets. They are things that you cannot touch, but they still hold value. Examples include, say, your established brand or company itself, secret recipes or secrets that a person holds that gives value, or customer loyalty, which is also known as goodwill. That is a great intangible asset. Usually on a financial balance sheet, most assets listed are tangible assets. This is because majority of tangible assets hold some monetary value. Now to get real technical, and probably a bit beyond what is needed to know for your average Joe, but nonetheless, we're all about that knowledge. Assets can be further categorized into long-term and short-term, or more professionally known as current and non-current assets. Current assets are assets that are easily liquidated, or more simply, assets that you could turn into cash easily within 12 months. A few examples to help consolidate that knowledge is, for example, share market investments, cash on hand, company stock, accounts payable, which is just a fancy term for people that owe you money. It is important to realize that the fancy world loves trying to confuse you like that at any given point. I mean, why would they make life easy? Anyway, non-current assets, which for some of you smarties out there can probably guess already, is assets that are not easily turned into cash. That would typically take more than 12 months to turn into cash. So examples of these would be, say, the land or property that the business owns, or if the business deals with, say, big machinery, that could be seen as a non-current asset. So on a balance sheet, these non-current assets are grouped in what is normally called PPE, which stands for property, plants, and equipment, not to be misunderstood as personal protective equipment. So now you hopefully understand what an asset is to a greater extent, and if you don't, rewatch the first part of this video again. And if you still don't understand, then feel free to abuse me in the comments, because I haven't done my job well. But if you do understand, it would mean the world to me if you could hit that thumbs up below to show that you understand. Now next we want to quickly explain how assets compare to liabilities. A liability in the financial world is quite simply any money that is owed by the business or individual. Some examples of liabilities for a business would be things like any wages that you may owe to employees, any money owed to suppliers for stock, or any tax that is owed to the government, etc. And for some personal examples of liabilities you might have yourself is, say, mortgage debt or car debt. And just like assets, liabilities are also categorized into current and non-current, that being money owed within 12 months and money owed after 12 months respectively. So if you've learned anything today, you'd be able to take an educated guess that pretty much assets can put money into your pocket, where liabilities take money out of your pocket. And if this is all you learned from today's video, then I'll take that as a win. Thank you guys for watching, and if you want to learn more about financial freedom, financial literacy, or help to achieve your financial goals, make sure you're subscribed to the Money Playbook and turn those post notifications on. And remember guys, if you're not growing, you're dying.